You won a Super Bowl. Talk about that shaping of the diamond, if you will, in these pressure-packed situations.
Being a CEO is just like everything is so easy compared to that job.
I want to welcome everybody to Buchanan's Counting Capital podcast. I'm very excited to have my special guest today. As you know, I'm Robert Brunswick. I'm chairman of Buchanan Street Partners and your host for today. It's my great pleasure to have Doug Brien as my guest today. Doug's a friend. I've invested with Doug. I've cheered him on from the stands, if you will. Doug today, he has titles from the past, but today's the co-founder, CEO of Mynd and Roofstock, a company that we'll learn more about in our conversations. Some of you might know him. He's a former Super Bowl winning NFL place kicker. I remember him kicking at Cal, where we both went to school. Doug got his start in the real estate business following the collapse of the housing market in 2009, when he and his partner, Colin Wheel, began buying single family homes to kind of renovate and rent out. What a novel concept. I think we now know, fast forward to 2024, where that market went. And Doug's a pioneer and could take lots of credit for some of its early roots. They were able to scale their business and into an industry where they ultimately had a $3 billion portfolio, 17,000 homes, attracted institutional capital, private equity. We'll talk about that today. With the success of Waypoint Homes, they became a validator of a very scalable asset class and for rental housing. So let's welcome Doug and let's get to know you a little bit. I can't help but ask the first question that I want to ask is about the football side. We'll get there, but maybe initially let's have our listeners get to know you a little bit. So what happened in your early childhood that you can kind of carry forward that maybe helped shape the man you became, the business person you became, passions, strengths, expertises that you seek, you've carried forward in life today as some of your great attributes?
Yeah, good and interesting question. I started doing therapy 3-4 years ago, and so this I feel like I need to lay down on a couch as Dr. Brunswick starts to, dig back into my past. But in all seriousness, great to be on your podcast. I didn't know you were a podcaster now, so you get to add that to your resume. But yeah, great to be here. I would say, it's interesting. Like it's one of those things, like nature versus nurture, and there's a lot of ambiguity in between the two. For some reason, I just was always hungry. I was just always ambitious. And, I'm sure that had a lot to do with my parents and my upbringing. I mean, I do remember specific examples. I have a brother that's 14 months younger than me. And, as you can imagine, we were pretty competitive. And there was one point where I was kind of a late bloomer and he was kind of an early bloomer. And my younger brother made the highest level traveling soccer team. And I didn't. I was playing in a higher age group against kids a year older. And they were in puberty and I wasn't. And, I can rationalize it all I want today. But at the time, I was just pissed. And I remember when nobody was home, I would sneak into his room and I would get his travel team uniform out and I'd put it on and I'd go out in the backyard and I'd just practice. And I was like, this will never happen again. This will never happen again. And yeah, so sure enough, the next year I finally broke through and made that traveling team. And I don't know, that's one example that sticks out. But for some reason, I just was always ambitious and hungry for more.
Well, I love the fact, Doug, that it came from within. I mean, you just said this was a self-driven passion to compete and be the best and to not lose out. And so we maybe fast forward that and we'll get the NFL out of the way quickly in college sports. But I sit often with my wife, we'll watch a football game, and she'd say, God, it's just not fair. These place kickers, there's so much pressure put on them to win or lose these games. So, I mean, you won a Super Bowl. You had some very tough moments in the NFL and kicking, I'm sure, and some wonderful celebratory moments. So, talk about that shaping of the diamond, if you will, in these pressure packed situations and what that was like, and moreover, how you carry that forward into your business life.
Yeah, I was all so soccer was my sport, right? That was, I mean, I literally didn't kick a football till my senior year in high school. And it was always my dad in the background saying, you're always the one that takes the penalty kick, the one who can take a deep breath and be cool, calm, and collective. You're always the one that takes the direct kicks from 40 yards out because I had a strong leg. Like, why don't you like you go to De La Salle High School? It's like one of the best high school football programs in America. Why don't you try kicking? And so I finally did my senior year. And it's interesting because like back when I started kicking, there really wasn't much in the way of coaching resources to learn how to do it. Like kicking a soccer ball is one thing, but truly kicking a football is another thing. There is a, correlation between the two. But I mean, it took me years of like really trying to find resources to like learn how to kick properly and, to actually turn into a kicker. But I don't know, it was interesting because my whole goal through high school was to play college soccer. And I had a chance to go play college soccer. I had a chance to go to a few different schools and play football and soccer. But when I finally got an offer, and that was a walk on offer, but an offer nonetheless to play for Steve Mariucci. Kind of crazy, right? Like he was an NFL coach for over a decade. He was my special teams coach at Cal, and he was a punter at Northern Michigan. Like he actually knew how to kick, and he got me all fired up about coming to Cal, and they had an All-American kicker, and they're like, Doug, if you keep getting better, when Robbie Keane graduates, like you can, like his spot will be yours, and his scholarship will be yours. But I mean, I was like, but I'm gonna get into Cal. So like that was kind of like the big deciding factor. But it was a big decision because I couldn't turn down the opportunity to go to Cal. Like I had pretty good grades, but not good enough grades to just get in for school. But I ended up having to turn down soccer because just playing at that time Pac-10 football and soccer is the same season. Like you just literally didn't have time to go to school. You couldn't pull it off at a place like Cal. And so I had to make a pretty big decision. And I just from very early on had this like feeling like everything came so easily when it came to kicking. I just had the leg strength. I had that natural calm disposition that it takes to be good. But again, it took, years to kind of finally get good at it. And yeah, I mean, so that story actually played out the way that, Coach Mooch had described for me. There was definitely speed bumps along the way, but I ended up, starting 3 years into my time at Cal, earning a scholarship. And, kicking is such a volatile position. I had no idea that the NFL was going to be calling at the end of my time at Cal. Like that was like never even on my radar. But when it happened, it was again just kind of like it was kind of. I mean, in some ways felt like Forrest Gump. It was like these things just kept kind of showing up. It's like, oh, get drafted in the third round by the Niners. Oh, win a Super Bowl your first year. It was just kind of this like surreal ride that ended up going on 12 years into the NFL. And so, I mean, I know the end of your question was kind of a prompt around the translate or the transition to business. And I guess the way that I would describe it is if you think about what kicking entails. So you talked about pressure, right? Like it's literally ranked, the most pressure packed job in the world. It's like pitchers, cornerback. I mean, there's just like very few roles where you're so isolated. It's so binary. It's either good or it's not. If you think about what it takes to be successful in that domain, it's like an incredible amount of preparation. All you do is prepare for that moment, mentally and physically. And so what you can put into it is sort of limitless. And what I learned was just to always, I mean, really use the growth mindset that I was, blessed with, right? So it was always mentally and physically, who can I talk to? How can I learn? How can I get better? Diet, ballet, martial arts, stretching, yoga, weightlifting, running stadiums, flying around the country to kicking. I did everything to get better at that moment. And it's interesting because one of my passions now is to talk to college athletes, really high school and college athletes, student athletes, about all the skills they acquire. I feel like most kids just don't understand the skills that student athletes have, that if you're competing at a high level in a sport, like there's so much of that that's translatable into business. So I just really took that approach, kind of a maniacal approach to like success and positive outcomes and the ability to focus in moments where few can. And my response is usually like, being a CEO is just like everything is so easy compared to that job, right? Not that it's easy on an absolute basis, but it's like in kicking, you got one moment and one chance. And as you know, when you're running a company, it's like something doesn't work. What do? You like learn from it. You bring in other resources. You try it a different way. Like you get so many different tries to get it right. And I just think that like training at altitude background I have as a kicker has just really prepared me well for business.
Well, great backdrop. And we won't dive into it too deep, but I know you were purposeful as you were wrapping up your NFL career to get an MBA, knowing that you wanted to pursue business. And so I call this the trade that Warren Buffett and Sam Zell missed. So here's Doug and Colin. Colin had a different background. You guys complemented each other well. You had this vision in 2009-10 when the world was coming apart, had come apart, uh, to to get into the for rental housing business. So paint that picture of vision as you saw the opportunity set, and then what Waypoint's approach to that was, and then we'll get into how that evolved.
Good use of the word waypoints.
Yes, sir. You taught me
Yeah. Yeah, it was interesting. So, when I got into the NFL, one of my, first thoughts was like, I'm not going to be one of those guys who has this amazing opportunity to play in the NFL, make some money, and have nothing to show for it. So, like, I kind of went to work on like, okay, what am I going to do with this money? And I had to learn, and I talked to a lot of people, and I quickly realized real estate was a really interesting asset class. It was tangible, and my brother and my dad and we had always grown up like renovating houses, so it was handy, and there was something about like taking that like eyesore of a property and turning it into something beautiful that just like gave me satisfaction. And so that, with everything I learned about the tax treatment on real estate, the ability to use leverage, 1031s, all that stuff, I spent my career kind of learning real estate. And as you mentioned, went to Tulane when I was with the Saints. And so, when I finished and I bought that first house, I bought my first house with my Super Bowl check after my rookie year. I kind of, again, went on this journey to learn real estate. And so when I finished in 2005, it just was like very obvious to me that I wanted to marry, the next professional endeavor that I was going to embark on with something that I was passionate about. And real estate was just, at the forefront of what I was doing outside of football. And so I joined a private equity firm that was focused on multifamily. Continued to learn more, just like soak up like actually being out in the business world. And I was raising money, we were buying properties, we were repositioning them, we were managing them, we were reporting and communicating with investors and all that fun stuff, which I know you know well. But it was interesting because at that same time when I was just getting started, that was kind of when the foreclosure crisis was happening. And the way I always think of it was I knew enough to be dangerous. Where and I know you remember this, and Scott Sellers from Archstone. It was like all the multifamily guys. They saw it. It didn't resonate, right? Because it looked so different than multifamily, and it was just hard to imagine how you could actually make it work at scale. But again, I knew enough to be dangerous, and I had as you mentioned, a colleague, Colin Wheel. Him and I kind of embarked on a project to underwrite it and try to understand it better. But like in 2008, we got enough confidence of like, you know what, the rest of these, real estate experts that don't believe it, like they're not seeing it, and we just had high conviction that we could figure out how to make it work. And so I left apartments and said, I'm gonna, like, why would I go buy 6 caps when I can buy 10 caps? Like, who would do that?
So let's talk about that. The trade was compelling, the basis play of buying these single family homes. So I'll never forget because proudly, I was one of your early investors and on your advisory board. And I'll never forget, the thesis was, we're going to make a high single digit, low double digit current return, and then a like-minded return on top of that with the appreciation given the basis play. And of course, the outcome didn't happen just that way. So, talk a little bit about that thesis versus what became reality and how you learned and evolved in this business model.
Yeah, I mean, I would say, yeah, I mean, return is part current return and part appreciation that's realized on the sale. And as you said, like the mix ended up being different. You know, knowing if we had known what we know now, and if we had the tools available to us that we have now, I don't know that would have been as far off of what we thought back at that time. But the truth is, we were trying to operate a different model with tools that were really made for multifamily. And there's just, a whole bunch of reasons why they didn't exactly work the way that they were supposed to in the single family context. And so it definitely took time, and there was an evolution to the operations. And I would argue that evolution continues today. I think the metric that everybody overlooked that kind of made the big difference, and I guess kind of made us right that single family could work from an NOI margin perspective was turnover. Like people in houses, just like, yes, it was more expensive to turn a house, but they stayed twice as long, right? So we were seeing residents stay over 3 years, where typically, you'll see a year and a half for multifamily. And so it's been a really interesting evolution to kind of see how single family operations and takes a lot of technology, a lot more than multifamily. In fact, I would argue single family has kind of led the way from a technology perspective. Self showings, if you remember, it's probably back in 2012. It was like we could not send leasing agents out to every single appointment. It just became untenable, and we were the first to experiment with self showings. And it's like that's literally just catching on now, and in multifamily. And to my surprise, there's still groups that like don't do it, don't believe in it, still think that you need like someone to show up with a smile on their face and open the door.
We're going to get into your current company and technology and operating efficiencies. And, are you in the real estate business or are you in the, an operating business? And you're a bit of both. But I think so to Buffett and Zell's views, this was a hard business to scale. And what you didn't know was good because if you knew it, you wouldn't do it. So the scaling of your business, growing that to 17, to owning and operating, renovating, turning, managing 17,000 homes. And that just was a Herculean learning process for you. I recall you hired some 200 people in the first couple of years, if I'm not mistaken.
Yeah, I mean the amount of people. Yeah, I mean people, operations, and look, I mean my partner Colin had scaled. I mean, I wouldn't even call it scaled. He'd started and sold a small business. I had never done anything like this. Like I was literally kicking footballs 2 years before. So there was a lot of learning, and we owe a lot of credit to you and other advisors that like we could go talk to about facets of the business that like were really challenging and we had less experience with. But yeah, I mean, I think at the end of the day, Robert, it's like there was a technology play here, and those guys didn't see it and they didn't understand it. And I think once they did, and once they saw that play out, then it became obvious.
Waypoint lines up with Starwood, Colony, Blackstone. So you got a very quick education about dealing with Wall Street and private equity, and share that a little bit, Doug. I mean, because they both were challenging at times. It's real estate's capital intensive. They were there with capital, They were there with experience, so you learned a lot from them. But I know there were some challenging days for you interacting with these folks.
Yeah, all of that, and in a new domain that neither of us knew, and there was no playbook, right? It's not like they came in with a playbook and said, it was more like, hey, you guys are the experts that how to do this. We know real estate, we know capital, we know generally how the economics of the multifamily business look, but we were kind of learning together. So yeah, I mean, I was learning about private equity investors and yeah. I mean, it was like it felt like really drinking from a fire hose. I mean, there was like learning and scaling the business. There was the interpersonal dynamics and politics of navigating and managing those relationships and making sure that they worked. Um, it took everything I had. I mean, there was a lot of deep breaths and you know using some of those old skills I had built to stay calm.
So the last step in that triumphant, as I mentioned, Starwood Colony Blackstone was Blackstone and Invitation Homes. So you ultimately sold out to Blackstone and Invitation Homes. Was that the final hurrah before we get into your next chapter as an entrepreneur?
Yeah, well, I mean, sort of. We actually started Mind before we sold to Blackstone. So when we merged with Colony, that's when I stepped out. So Gary Beasley, who I'm now working with at Roostock, and Colin stepped out a year before the Colony merger. I had an opportunity to roll forward with that company and decided that I wanted to pursue entrepreneurial endeavors, start Mind, start something new and fresh. That was really the answer that I thought the industry ultimately needed. We can get to that later. But yeah, so a year later, we sold the GI portfolio. So if you remember, there was a management company and we had like 10 funds. All those funds sold individually. A few of them we sold to retail, like to homeowners, one at a time over time. I think the fund that we worked on together, that Southern California Friends and Family, I believe we sold that one at a time to homeowners. That was just the exit that made sense. And by the way, it's a really dynamic with single family. You can sell to yield investors and you can always just sell to homeowners. And today, by the way, huge arbitrage. If you sell to a homeowner, you can literally in most markets get like 20% more than if you sold to a yield investor just because of where interest rates are today. But yeah, so that happened a year after, but that was our biggest, like if you kind of looked at these as a bunch of little micro exits that added up to an interesting exit. Like that was definitely the most interesting. I mean, it was 3,100 homes that we sold. Um, and ultimately, yeah, to me today, those houses are literally with Invitation Homes.
So, many things impress me about you, but I think of you as you continued to be an inventor. You continued to innovate. So as I look at Mind, and when you came to me and told me about this investment thesis, share with the audience just what was the vision of Mind. Obviously, it's evolved today, which we'll get into with Roofstock. But where did you see an opportunity to continue to be a pioneer in the single family rental space?
Yeah, I mean, so I would say one of the things as an entrepreneur that interests me is kind of trying to figure out like what are the structural problems in like industries that you have some knowledge and some passion for. And look, technology was a structural issue. And I would argue in some ways it still is. Like all the tools, all these big companies, literally even still today, Invitation Homes, Progress Residential, they use Yardi as their back end accounting. And that is software clearly built for multifamily. And everybody knows it has tons of challenges with regard to single family. And then what's ended up having to happen, because there really aren't purpose built software platforms similar to what you'd see in multifamily for single family, you end up with a dynamic that we call swivel chair management, where literally to manage a portfolio of single family homes, someone on Invitation Homes team, not to pick on them, it's really true for everybody in the industry. It's like they're literally working in 8 systems. Leasing happens in one system, operations, data visibility in one system, accounting and financials in another system. I mean, there's literally 8 or 9 different systems. And it's just like any technologist would look at that setup and say, we can do better. And so what we did at Mind was say, and look, it was way more audacious than I thought it was originally, but said, okay, we're going to build purpose-built software for single family at scale. And by the way, what I saw was really a really compelling asset class being delivered to institutional investors. And with my, individual investor hat on, I asked myself, like, why can't for an average retail, an average individual, or a small family office, like why can't being why can't investing in single family look more like buying stocks on, a Schwab trading account? Like, why can't it be more like that? And look, it's a long journey to get there, but I think it was really kind of making the best tools and a really compelling asset class available to retail, mom and pop retail investors, and building the underlying technology system for the industry was really the goal with Mind.
You're going to correct me. I think of Mind when you rolled it out as an infrastructure support company, management software provider, but I didn't think of them as an owning and controlling real estate. But if you'll correct me, but didn't Mind evolve to the point where you started to get back into buying houses?
Yeah, but so the big distinction between Waypoint and Mind is that at Waypoint we were a principal, right? We spent a lot of time raising both debt and equity. And that was actually one of the takeaways. I think every entrepreneur, like as you go from one business to another, it's like you got to take that moment to say what worked, what didn't work. And, clearly one of the things that we thought didn't work and we saw as an opportunity was like the technology was really the big missing piece in the industry, yet we spent over half our time raising capital. And so the big idea with Mind was let's not be principals ourselves. Let's invest in the underlying technology and, process routing to build a platform that retail and institutional investors could use. So still today, I mean, there's some caveats with our story here at Roofstock, but at Mind before the merger, we didn't own any real estate assets. Like we had 18,000 properties that we managed. We didn't own any of them. They're all owned by 5,500 retail investors, 20 institutional investors. And so we were a service platform. We provided technology and the service, which meant people, process, and technology. And we got paid a fee for it. And venture investors valued the company based on a very attractive multiple on revenue. And it was funny because like a lot of traditional real estate investors would hear our model and say, so you're not getting any carried interest. Like, what are you guys thinking? And then I explain the economic model and they're like, oh, that's interesting and very scalable. And, you can build value pretty quickly this way.
Yeah. Well, that's helpful. So Mind is going along well. Market challenges, as we saw, we've experienced in real estate. So talk about the merger with Roofstock. Why does one and one equal three? What compelled you to move forward into yet this next challenge or experience in your business career?
Yeah, I mean, at the end of the day, what started with just doing property management evolved into an end-to-end service platform. So I'm going back to Mind. We were working with retail investors, we were working with institutional investors, we were helping them buy, finance, insure, and do all the management all in one homegrown software platform. So a full end-to-end service. And then we ended up taking on some large institutional investors that wanted to deploy meaningful capital. This was like, call it the 18 months before the Fed started raising rates. And during that time, we deployed $500 million and we're really ramping up towards that same kind of pace we had at the peak with Waypoint. And there was a lot of investment and infrastructure that was built to enable that deployment of capital and everything that goes along with that. And so when the Fed started to raise rates, that buying shifted very quickly. And I would say between us and our different investors, there just was not clear visibility into how long this would last. I mean, all of a sudden buying went to almost nothing. And if you looked at our revenue, it was like half property management revenue and half acquisitions and financing revenue, which is actually higher margin. And so that all went to nothing. And I would say what what hit us hard and what also hit the industry hard was just like everyone had built up these capital deployment platforms and then got caught a little bit flat-footed and just clearly didn't react quickly enough. And we just never kind of got to the scale from a management perspective to have enough recurring revenue to support the entire business. But I also knew that companies smaller than us were struggling even more than us. So I actually kind of hearkened back to my Waypoint days when I think it was really 2014 to 2017 when we merged with Starwood, and then Starwood Waypoint merged with Colony, and then that company merged with Invitation Homes or Blackstone. It was the same dynamic where all these end-to-end platforms had been built up for different reasons. Capital stopped flowing. If you remember, private equity really wanted 20% plus IRRs, and just like prices had come up so much since Invitation Homes got in the game, you just couldn't credibly underwrite 20% IRRs. And so all that private equity stopped flowing into the business. These companies couldn't scale. What happens when, what do you do when that happens? You look right, you look left. I mean, industry consolidation. How do we combine with other companies to help our businesses survive and then thrive when the market changes? And that's why we did what we did with Starwood and Colony and Invitation Homes. And frankly, that's what's happening with the market today, consolidation. And it was November of 23 where it was just like abundantly clear. I went to our board and I said, we need to merge with somebody else. Like, I think we can get a really interesting outcome, but we don't have the capital runway to make it through this. We keep thinking, next year's going to be the year when rates start coming down and buying activity starts happening again. And it just didn't. And it's still not. And it's still murky as to when that's going to happen. And so I'm really glad we were one of the first companies to start taking action and made a really compelling deal happen at a time where I think it continues to make sense for companies in our space to combine so they can make it through this.
So let's unpack this a little bit more. As a Mynd investor, when I heard about the Roofstock merger, I didn't so much think of it as driven solely by financial necessity, but also reaching out to the vision and the evolution as you saw it and the continued, as you say, consolidation of the asset class. So what is Roofstock? Why are you so excited about it? And how are you melding the two companies and cultures, and what's that like? Kind of a two-part question, but let's unpack what Roofstock is.
I was co-CEOs back at Starwood Waypoint with a guy named Gary Beasley, who we brought him on really, he was in those same early funds you were. He was like an advisor and investor. So this is Gary Beasley at Waypoint. And then as soon as we started getting serious about private equity, he had a private equity background. And at one point, Colin and I just pitched him and they said, you've been involved with us since day one. Why don't you come join us? And he did. So we worked together at Waypoint for 5 years. He left a year before we merged with Colony to found Roofstock. And so if you think about it, we worked together for 5 years. There was kind of this common shared vision, lots of opportunities and problems to solve in the single family rental industry. The one that he went to solve was kind of what I would say is more on the investment side of the business. Why is it that you vacate a home to sell it, only to sell it to another investor to find a new tenant? There was just all kinds of things broken about that dynamic. And so they went really deep, building technology and kind of a different workflow to the way the business should work on the investment side of the business. And so then when I left after Colony, Colin and I said, well, there's the management problem. In most real estate asset classes, I think property management is generally considered somewhat of a commodity. Single family, it is non-trivial. If you can't manage at scale, doesn't matter how well you buy, you don't have a business. So we started on that side of the business. And really, it's interesting, over the 6 years, we're both kind of growing towards this full end-to-end service platform that did retail and institutional. And so what I would say is, Roofstock and I were, and Mynd were kind of the two big venture-backed single-family companies. Both had leaders that had been in the industry forever. They hit it out of the park in terms of capital raising. So they raised $240 million, like literally right before interest rates started to tick up. So they had this incredibly strong balance sheet. But in some ways, their business was hit harder by all of this because they were so much in the transaction business. And so, Gary and I have remained friends and colleagues and always kind of swapped notes. And at one point, it just became an obvious combination. It's sort of like, why don't we get the band back together? Like, we have the recurring property management piece. You guys have all the data. They had this tool called the rental genome with all the data on every home in America, and they had this really strong transaction business. Like, why don't we bring the two companies together? I know we can cut a whole bunch more to make this like the best in class business. And so it's like, I would say for both of us, there was a necessity to do something. And I mean, this is how, mergers really work. We were both looking forward at like the recovery that was not debatable in our minds. It was not an if, it was a when. When is the capital going to come back into single family? And it's like, what do the companies that succeed and ultimately win look like? What are the capabilities that the winning companies have in the next cycle? And we just really felt like together, if we kind of bring these companies together the right way in a year or two, when the market returns, transactions start to return, we can have a very successful company that allows both companies and all of our investors to win in a very challenging, after going through a very challenging market.
So, Doug, I want to be clear for our listenership. Ownership and operations is what I'm hearing with Roofstock Mind. So, Roofstock's a platform that can allow an investor to come in, buy a home as an investment. You manage it for him. They get a check like they would anything else. They take title to it. Is it partial ownership interest? Just make sure we understand.
No, all the houses are owned by investors. So think of us as a service platform. That, with the one caveat being, and this is like very nascent still, before the merger, Gary and team had started what they call Roofstock Capital Management, RCM. So there is a burgeoning fund business that we're building. And part of it is like just this like realization we're so dependent on outside capital, because like, look, in certain parts of the cycle, that's really great because it's capital light. But when there's no capital and you need capital, it helps to have control of capital. So what we're doing is looking at building. I mean, you can almost think of it as a gray star of single family, like fund business, management, data, all the embedded services. That's sort of what we're building towards. And it's interesting because, gray stars come into single family, specifically build to rent. We think we can do build to rent and ultimately multifamily. So we're really looking at like together building a category killing residential management platform that both has capital to deploy into the space, as well as the ability to provide end-to-end services for both retail and institutional investors.
So, Doug, a perfect handoff for me, and I'd be remiss if I didn't get your perspective on this. There's been much media noise about all the flows of capital, institutional capital, to buying and growing and validating this single family asset class that's really disallowed or prevented or hurt or impacted, competed with that first time home buyer or a home buyer that now says, how am I going to compete with institutional money that will close in 24 hours and has a different investment thesis? I just want to own a home at the corner of Main and Main and grow my family there. So is this good for that first time home buyer? Is this what's changed? Is there a paradigm shift up front? Help us understand how you're maybe helping and hurting at the same time.
Yeah, I mean, look, it's a controversial topic. I mean, we all read about it in the paper. It's something, we all have to be aware of. I mean, I think of it as a reinventing or a recontemplation of the American dream. Like, I saw it firsthand. I mean, I know you did because you were working with us, Robert. It's like, owning a home in America has always been up and to the right, and people were not properly diversified. They had all their eggs in one basket, and that was all well and great right up until the minute that it wasn't. And then when it wasn't, it was really bad. And you had a lot of American families get really, really burned by having all of their eggs in one baskets, and arguably owning too soon maybe in their life. And so, data suggests people still want to own homes, but it also suggests that they want to own them later in life. They like and appreciate the flexibility of renting, being able to be in that higher end neighborhood with the better school, but not being able to afford it, being able to, easily move to the better job location, being able to diversify your investments, into a diversified basket of investments instead of having all your eggs in one basket. And so the way I see it is the single family rental industry has just grown out of that reality. Like, there is a need from the market. Think about what it used to be like what the customer experience used to be to rent a home. Like, it was a big market, yes, but it was like, go on Craigslist, call a mom and pop owner, try to get a hold of them. If that house isn't a fit for you, you're like literally dialing for dollars. It's just a really hard, bad, unprofessional service. And so what's happened is yes, the foreclosure crisis was kind of the catalyst to start the industry, arguably because we saw the traditional old historical American dream was kind of exposed, right? All of a sudden, you had people that wanted to live in a house and they wanted to live in the same neighborhood. They just didn't want to or couldn't own their homes. And so today, you have you know millions of renters who are renters by choice, a whole industry, a professional industry where you can go to a website and we can curate a list of homes that you can easily go see with a self showing. You don't even need to go meet a person. You can literally get a code and go see these homes. Like, it's a whole industry that's grown in response to what I think is a need. I mean, the most frustrating part to me about the media, I think, unfairly characterizing the single family industry as being predatory, is this reality that the real boogeyman is supply. Like, there's just not enough supply, and we're not building enough supply. And I think the sooner we can get focused on solving that problem, we're going to have a better chance to have plenty of homes for those that want to buy them, and plenty of homes to continue to grow the single family rental industry. Because the fact is, there are a lot of Americans who are choosing to rent homes, and they like the professional experience that they have today.
Well, that was probably one of the better answers I've heard to that subject matter. Perspective explanation was great. And I'm a big believer in diversifying your assets. And I think the paradigm shift is a reality. And I think many now just prefer to own a home. They can live in a nice or rent a home, and they can live in a nicer home for their family with more than they might have otherwise been able to afford if they needed to, if they wanted to go out and buy something.
And Robert, the other really cool thing that we're seeing, and I'm still kind of trying to formulate how to pull this together and support it with data, but I think of it as like decoupling of the house you live in and the house you invest in. Like, what we're seeing both in our own portfolio and you hear anecdotally about in the market is people who are choosing to rent a home, and yet they still do have home ownership, and they have skin in the game, and they have equity because they're buying rental homes. It's so much easier. Like, literally, platforms like us have made it more compelling to rent because it's a professional experience. And then they can go maybe buy 2 or 3 houses in Indianapolis and Dallas and Orlando, and be diversified. And so it's like there is this fear that because people are renting longer, they're not going to build wealth. And I think it's a legitimate fear, but we're already seeing people buying homes. And one of the things we're trying to innovate on, if you remember at Waypoint, we had that Waypoints program where we basically rewarded residents who, renewed and took care of their properties and passed inspections and kind of did the things that made for a better investment. We want to kind of bring that back to life and help our residents actually earn credits that they could deploy into fractional ownership. Fractional ownership in single family was not a thing back when we were doing Waypoint, but today it is. And there's actually a world where you can own, in $100 increments, a piece of a rental property. And so we see this really interesting opportunity by leveraging the scale of our platform and data to actually help residents start to build equity in real estate, even though they're renting. So when the day comes, if it comes, that they want to buy a house and they want to have enough capital to do so responsibly, not being over focused in one asset, then they're in a better position to be able to do it, and kind of everybody
Two
wins.
quick questions before we move to maybe some wrap questions as we close. How many homes does Mind Roofstock oversee today from a management standpoint, if you will, ownership, just touching homes?
We're at about 18,000, and literally by next week, it'll be closer to 20,000. And we think we can grow that meaningfully in the next 12 to 18
And
months.
who owns the company today?
I mean, it's a combination of all the venture investors that invested in Mind, all the venture investors that invested in Roofstock. I mean, there's probably 15 or 20 different venture capital investors who, own pieces of the company. And then there's, founders and employees own a good chunk
And
too.
is there a public, you're private, is there a public vehicle that's doing this today?
Not what we do. I mean, obviously Invitation Homes. I mean, there's other REITs out there, but they're different. I mean, you would own a security interest in a portfolio of homes that's owned by the REIT, whereas we're a service platform for both retail and institutions, and we help with portfolio sales, one-off sales. We buy portfolios, we buy homes one-off. We can help you with financing, insurance, and all the management all in one technology platform. So I would argue there's no public company that does what we do. And I know what your next question is, and the answer is yeah. I mean, look, Gary and I have run a public
I didn't
company
think I
before.
could
So
ask that question.
well, you can ask the question. I mean, it's like, at the end of the day, I think our position is there's a lot of different directions we could go with the company. But if you build a company to be a public company, then that gives you a lot of flexibility to do the thing that makes the most sense for the company. I mean, going public for the sake of being public, after our experience being, co-CEOs of a REIT, is not the thing to do. You need to do it for the right reasons, whether it's liquidity or access to capital. But I think that's something that we want to prepare the company for if that opportunity arises, and it's the right thing to do for the
So,
business.
Doug, we have a lot of younger listeners on this podcast, parts, of families that have their children, that adult children that are learning about investments, learning about different asset classes within real estate. So I would love you to kind of lean into sharing with us what's different today, just business wise, than maybe when you started in the business, and why is that good and why is that maybe a challenge?
I mean, look, this is what I tell young people all the time, Robert, is like, to me, the world is changing so fast, business is changing so fast because of the, exponential speed at which technology is advancing. I think real estate is interesting as an asset class for a lot of different reasons. To me, single family needs technology and data perhaps more than any other real estate asset class. And so, what I think is really interesting about single family is, look, I mean, young people just understand technology better. Like, if you look at generative AI in the single family use case, I think specifically, not only around property management, but in general, like, it's transformational. Like, we are really leaning into this in a way that I don't think anyone else in the single family rental industry is. It's going to be completely game changing. Like, we literally think we can lower our cost structure by 50%. Look, young people just like, they're closer to it. They've grown up with it. They're living it during their formative years. And it's such an important integral part of single family. I just think young people can learn real estate. Like, there's something to it. It's not rocket science, but if you understand how to apply technology to business, like, there's no greater opportunity in real estate, I don't think, than single family, because of the power of the new technology that is being innovated as we speak.
Helpful. As I think about when you built Waypoint, I remember because my son-in-law and son both worked there. You were a passionate guy because of team sports, I imagine, for culture. But as I think about today, what you have built and as this company evolves, share with us your favorite aspect of the job. So, what gets Doug fired up in the morning?
Yeah, I mean it's what you just said. And if you think about how, Gary and I are dividing and conquering, I mean, he's been a public company CFO and CEO, like he's got, a decade plus more in like capital markets experience and he's really great at it, has amazing relationships. Where my passion lies is like building a team and creating a shared vision that gets everybody excited to get up in the morning and go to work. And so I think, that was always a big part of my focus at Waypoint and Mind. And it is now at Roofstock. Like we just instituted, it's been quite painful. Like we have people back in the office now 2 days a week, and we are starting a hiring plan that's going to concentrate people in the markets where we do have offices. We have a new set of values that we just came out with, and one of our very important one is better together. It's like there's no question in my mind, especially in an industry like ours where when you get people together and you have that shared vision, magical things happen. And it's just, it's fun to be on a team. Like I just went to the climbing gym with another guy who used to be on the Roofstock team. Now we're on the same team and we're like, getting to know each other in a different context. And I'm trying to create like, a rock climbing activity that where everyone in the office goes to the gym down the street once a week and, do all kinds of fun stuff like that that just brings people together. But at the end of the day, everybody likes to be on a team and everybody likes to win. And it's like if you can create that kind of dynamic, I think you build a great team and people that want to stay on it and ultimately
So,
win.
just to be clear, because it's a takeaway we've talked about many times, work from home is not what Roofstock's offering to their employees. Is that correct?
No, that's not exactly right. What we are offering today is a hybrid work opportunity. Because the truth is, like, we are building technology, and like, look, there are certain activities in our business that, like, I would say, hey, you should just be at home and have your and just grind and write code but like you also need to be spending time with the operating teams and understanding the business and it's a very cross-functional business. So what we're saying, at least for today, because we hired all over the place, both companies. We're not all in, we have over 900 people all over the world. We just cannot snap our fingers and say, back to the office. It's like we have 3 offices. We're going to probably add to those next year. The people within that radius, we expect you to be in twice a week. And the idea is like there's just a little bit more carrot than stick. Like I believe once people kind of rebuild the muscle memory around coming into the office and all the fun that comes with it and all the productivity gains that people are just going to want to be together more in the office. And Gary and I are working hard to create like a really compelling office dynamic and culture so that people want to be here.
Very well articulated. So, last question for you as to our younger group. What advice might you give someone today starting out in business as to how they should approach it, things they should think about?
I mean, look, it's a cliche to follow your passion, but I still think it's true. Like I just know way too many people in my career, and I know you just in my life. I mean, I know you do too. It's like once you get on the treadmill of just chasing dollars, I think it's a hard treadmill to get off. And I think you have to be really careful that there's that old you know analogy about just climbing the ladder, and then someday you get up to the top and you look around and you realize you climbed the wrong building. I just feel like if you can make sure that like you are passionate about what you're doing, the contribution that your business or whatever you're doing makes both to the business. I mean, look, things have to make money or they're not going to survive, but also to the world. And the people you work with, like that is how you create a fulfilling career. And guess what? If it's fulfilling, you're going to want to do it more and you're going to want to do it better. And guess what? You're probably going to end up making more money than if you would have, solely chased dollars. And so the only other thing I would add today is just like, I think the power of generative AI technology is like, it's like the internet and maybe even more so than that in terms of like a paradigm changer. And it's like it's super ironic to me because People used to always say, well, you're like, you should be an engineer. If you be an engineer, then you're safe. It's like, no, generative AI is real agents. Gen AI agents are really good at writing code. And so I just think, look, my wife's a lawyer. Luckily, she's a recovering lawyer, but like lawyers, the legal industry is going to get completely disrupted, right? Like, think about like, they have to go read all these books and write these case summaries. It's like Gen AI can do that like in a minute or less, what would take, a lawyer days. And so I just think you have to be very cognizant around what this technology can do and what it can't do. And kind of going back to your question to me about culture and people, like at the end of the day, we, still are going to work in teams. Like companies are going to do better working in teams. And I think those roles that bring people together, people that know how to bring people together, know how to connect ideas, especially as, the technology that we have available to us evolves. Like that is where the magic happens. Those are the roles that aren't going to be replaced. And I just think you got to be mindful of that.
Doug, I can't thank you enough. We've known each other for a long time. You didn't disappoint today. We like to phrase it good learning at Counting Capital, and you provided that today. We got to have you back for sure, because there's much more we could touch upon. Just a few of the takeaways I made notes here. Nature, nurture. I haven't heard that from one of our guests, and we've had many, but I like the way you framed that and the way that you talked about that isolation of your prior experiences and the binary position it puts you in, and how that really has helped you compartmentalize in your business life and to stay focused and bring the discipline to bear. I think there's a great takeaway for a lot of people. Your success is clearly not accidental. It's very purposeful, and you're truly a pioneer in the for rent single family space. And I can't wait to see what you continue to do. So thank you for your time today. I hope to see you soon. And up in Tahoe, we got to get another bike ride in. I missed you this trip. Yeah. So thank you.
Yeah, it was great to be on your show, Robert. I really appreciated the time, and it was fun to chat and catch up, and I look forward to next time.
Absolutely. I look forward to seeing everybody on the next episode of Counting Capital. Thank you for your time today.
Thank you for joining us on this episode of the Counting Capital podcast. For informational purposes only and not to be relied on in any manner as legal, business, financial, tax, or investment advice. Nothing in this episode is an offer to sell or the solicitation of an offer to buy securities. To learn more about Buchanan Street Partners, please visit our website at buchananstreet.com. Buchanan Street Partners, capital you can count on.